I thought this chart was interesting. It takes the market cap. So the blue line on here is the market cap of the largest stock relative to the 75th percentile stock. So what's the that ratio between those two values look like, and that's the scale here on the left. Scale on the right, this is in percent terms. This is the weight of the top 10 stocks. Now, I know late last year, the top 10 names in the S&P 500 were pushing above 40%. That is the highest level on record. You can see this goes back to around the early 1980s for at least for the gray line. Again, in terms of tracking the percent of the S&P 500 that's in the 10 largest stocks, and you can see we're easily at the highest level ever seen in that series. But what's notable is that this blue line there, it'll take this data series all the way back to before the Great Depression. We're basically at a level that matches where we got to in late 1929, heading into the Great Depression. Again, looking at the market cap, the largest stock, relative to the 75th percentile. And so it speaks to the concentration and the swelling market values that you're seeing in relatively few stocks. And I think where you're starting to see these bubble bursting concerns come into play is that the market is now starting to call into question these valuations that they're assigning to the top stocks. And that's what I think you're seeing with the recent earnings reaction, because a lot of these AI hyperscalers, the money they're spending, the free cash flow for several of these names goes negative this year. I think Microsoft might be the only hyperscaler right now, based on spending plans, that is expected to be free cash flow positive. And at the same time, we're seeing a big jump in debt issuance to help cover that cash shortfall. And so, those concerns I think are definitely coming into play. And there's a way to look at that.